This
Good,
meeting is being recorded.
good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. Back with Taylor from Life Goal Investments. How you doing, buddy?
Doing great, doing great. Watching this market, it's been a tough one.
Man, I got to tell you, we're so lucky to have you on the channel, giving us the kind of Wall Street purview of this. I appreciate you reaching out. We're going to talk about kind of an unfun topic, but one that I've been warning my fans is coming. So I don't know. Does it feel good to be right? And there's so much pain. I don't know. I got to think about that.
We're in the same camp. We've been saying the same thing. We've been the Bears, and I don't like to be pessimistic.
I don't either. It's not natural.
Yeah. Yikes. Yeah, so no, it's not good to be right when right is being so darn wrong.
Yeah, exactly. And unfortunately, as I said, headline number one on my daily financial news, more pain ahead. We have just started. It's just starting. I know everybody wants it to be over. I know there's lots of people that lost lots of money. I don't have good news for you. Bear markets last an average of 261 days. The average bear market in the last 19 decline is 38%, with the worst ones being over 50. And I think this is going to be a worse one. You actually went ahead and got some 2018 stats because that was the last time the Fed raised rates and smashed the market. What do you got there? And we can talk about it.
Yeah. So during 2018 was a tough time for the market as well as the Fed began raising rates. The S&P 500 sold off from its peak at that point down a little under 20%. So it's a 19.5% is about what it sold off. So for context, right now, we're down about 15% from the peak on the S&P 500. Yeah. But the difference is we saw 4 rate hikes in total in 2018. So for context, right now, the Fed is trying to track down inflation at 8.5%. Like that's a crazy number. And the market's anticipating a total rate hike of somewhere between 10 and 12 moves. So if 4 produced a negative 20% return in 2018, what's to say we couldn't see down 30% this year, something like that, which is double from where we're at right now. And I don't like saying it, and I don't want you all to hear it coming from me. Don't shoot the messenger, but that's just what we're looking at right now.
Well, you go ahead and point at me. I've been calling for this for months now. It's a cleansing process, and frankly, we've had 2 years where risk was zero. We had 2 years where anybody could create an EV company, a crypto, a coin, and the easy money would just chase it. I mean, look at Lordstown Motors today. I think the stock's $1. Their balance sheet doesn't have a lot of cash. Lordstown Motor, without question, has to raise public money. Unfortunately, they're going to try to raise in a market where negative earnings doesn't get a great valuation. Lord's Motors, I don't know. I think their chances of raising money at any kind of fair valuation is not good. The best they can hope for is a significant down round. But I think the EV space is going to be the search engine space of my era. When I got smashed in a bear market, there was 20, 30, 40 search engines. And as we know, the party ended with Google's domination and maybe a token here or there. There was Excite and Ask Jeeves and all of these others that poof, were gone. It will happen in the EV space as an example. And it has to happen. Risk is not zero. Correct. And the Fed broke everything. Now, let's realize the Fed needed to do the first year. I think the first year of rates at zero and bond buying and being the backstop was okay, but they did it for 24 months. That last year overcooked it. And now we have a massive hangover.
Transitory was certainly not transitory, and they're eating their words on that right now. And what people have to realize is it's not just the fact that now inflation's high and we're trying to track it down by rates moving up, and that's why stocks are selling off. You also have to realize what valuations were coming into this bloodbath that we're seeing right now. So coming into this year, large cap growth, which had been the epicenter of people making money, whether it was EV companies, whether it was your ARK investments in Cathie Wood, doesn't matter what it was. If it was large and it was growth, a FANG stock, whatever it may be, it got pummeled with money and the stock price shot through the roof. Coming into this year, the large cap growth sector of the market was trading at 144%, 144% of its historical price to earnings ratio. So you look at it right there. You can take that down to 100 right off the bat, and all of a sudden, that's ugly as it is.
That's
and
a 30% whack. Yeah,
exactly right. And that's not counting the fact that now we're going from, zero rates to taking them up commensurate with what we're seeing in the inflationary market. It's tough. And to your point, those folks that are raising money on these unprofitable companies, they're not only going to be raising money into the face of this headwind, but also they're not going to be the only ones doing it.
Yes.
It's gonna come across, and everyone's gonna have to raise money for these unprofitable companies at a time when people don't want to spill cash into these cash, disposing engines that they are of just burning through cash. It's a scary proposition right now for younger companies.
Yeah. I mean, again, I can only tell you the experience I had, again, Silicon Valley.com era. There was a company, this isn't the first time we've done this. There was another time 20 years ago where companies were valued on revenue, not earnings. And if revenue was growing at 100%, that was like magic, because the idea was you would grow into profitability.
Yep.
I wish I could remember the name, but there was a company that sold some widget. I don't remember what it was. Basically, they sold the widget and wrapped it in $100 bill and then sold it for $98. Guess what? They sold a lot of widgets. They had crazy revenue growth. But that model never works, right?
Yeah.
You don't sell a widget.
What do you have to?
Yeah.
What? Sorry to cut you off. What do you have to do in order to allow that business style to work out, where you're just financing future growth? You have to, if you're losing money, you have to take on more and more debt. What happens when the Fed raises rates? What happens to that debt?
Let's be clear. It's when the Fed takes risk to zero, bad companies thrive because they just borrow the way, or they sell shares because the capital market's just keeping them alive. But if you make a widget, wrap it in $100 and you sell it for $98, I guarantee you will eventually run out of business. It does. More sales is not more money. It's more losses. And we have companies today like Lordstown Motors. I read their earnings announcements. The material to make their car costs more than the car itself. You tell me how that's a profitable business.
Michael, that's a market penetration strategy. That's all that is.
That's a company going bust.
No, exactly right.
Yeah,
there are very few, and there are some that have done. I mean, your historical case in point would be an Amazon. Amazon did take that lost leader and run with it for market penetration. It's not that they don't exist, but to your point, Warren Buffett's greatest comment, or one of his greatest quotes of all time, is, you don't know who's swimming naked until the tide goes out.
Yeah.
And right now the tide's moving out, and you're looking at these companies and go, okay, you better show me something where the bottom line is positive, or this financing is coming to a halt very, very quickly, and liquidity is just drying up.
Yeah, it is going to get very cold. I've been telling you for months that winter is coming. Well, good news, winter is here. Yeah. I believe this is going to be a very, very bad winter. Lots of records being set. It's just going to be bad.
Yeah, and I'll just reiterate the stats from the beginning, because it just shows you the context. In 2008, we had 4 Fed movements of 25 basis points. So that's a total of 1%. Right. And we saw a negative 15% movement in the S&P 500. We're talking about getting to a total of 2.5 to 3.5%.
Yeah.
So you're looking at, a 2.5 to 3.5 time multiple of what we saw rate movement wise in 2018 that caused a negative 15% return. It's not to say that we're near the bottom right now. It certainly could see more pain and more downside. And I don't think that the retail buyer, which is, I hate to put it, smart money, dumb money, et cetera. Smart money, I think, has recalibrated and moved.
Correct. Oh, quickly. Yes.
I don't think the dumb money has left.
No.
I don't. And that's the last shoe that drops. And that's usually a painful drop, because as we've seen, dumb money is becoming a bigger and bigger portion of this overall stock market that we've seen. We see that right now about 25% of trades that get placed in stocks are retail driven trades. Mm-hmm. That's far more. That's a multiple of what it was 10 years ago. Mm-hmm. So that's something where you go, okay, if that hasn't moved yet, and that has yet to move, it's not that all of it's going to go away, but some of that's going to sell, and that's going to, carry this further down. And I'm with you, Michael. I think there's more downside ahead.
Yeah, we haven't had. Go ahead.
You're going to get some bounces. So you're going to get periods of time where it's called a dead cat bounce, is what it's called in the market, where all of a sudden you see a 5% pop and you go, Taylor and Michael are idiots because they told us there was going to be more downside. but it's going to retest and probably blow through that downside again. This is a paradigm change in monetary policy is what it is.
Yeah. Here's the market always is a representation of future earnings times a multiple.
Yep.
I have bad news for you. Both of those suck right now. Earnings are going to go down. We are going to be in a recession. Shoot, we could be in a recession today. Most importantly, the multiple, right? The multiple coming into this was at a record high, 26 or some crazy number for the S&P 500. That could get whacked to 15 or 16.
Yeah.
Even
That's
if earnings
not far
don't
off historic norms. Yeah.
Yeah, exactly. 16 is historic. And I don't think we're going to be historic. We're going to, in my experience, it always moves in extremes. We've been way out. The Fed had the party going with all the drugs and alcohol you could want. Now they've taken it away, and that freaking hangover.
Yeah. There's a great word for that describes the market all too well because it swings to extremes. The word is a long one. It's called enantiodromia. And what that means is a tendency for things to swing towards extremes.
Yes.
And that's exactly what we see in the market every single time. And what did people miss this? Well, people didn't miss it, but I think people are underestimating the power of this, of what Jay Powell did last week in his conference. He went from saying, I can perform a soft landing. And I think everyone knows at this point, but a soft landing is him referring to the fact that they can raise rates to cut off inflation without forcing us into a recession.
Correct.
He went from saying we can perform a soft landing to a soft-ish landing.
I agree. Not many people pick that up. Yeah, that's a big deal.
That's him saying that we might break this thing.
Oh, no, I think it's an acknowledgement that we're gonna break. I think I think actually what he said without saying it, he's like, it is so bad, I have to break it.
Yeah.
I think that's what he said.
And full disclosure here. We should see a significantly lower inflationary print coming out on Wednesday than we did last month.
All right. Well, let's play the over under, smarty pants. So last month was 8.5. I'm personally calling 8.2. So you want the over or the under?
Under. I think there's three real reasons why I take the under on that. Okay. So one is when you look at the comparables. So you look at it compared to a year before, the comparables are getting higher because inflation started.
The base effect is rolling off. Yep.
Right. So there's that. Oil's now moderating some where it's gone from 130 down to 110.
Okay.
And then the last point would just be, I tend to see what the market says is coming in the future and say the market's usually at least pretty directionally correct. And the market says right now, 5 years out from now, inflation will be back at 2.5%. So it's got to come down pretty dramatic. And like that laugh is serious. Like that's so low relative to where it is at now. How does it get there? Yeah. But directionally, it says it's got to come down.
Directionally, yeah. All right. So you want to just throw a crazy ass guess? What's your crystal ball say Wednesday CPI is going to be? Headline number, not core.
So I will say this: average analyst estimate, which this is like seeing what the average person says and then saying what I see. Average analyst estimate's at 6.2%.
Shut up. CPI 6.2.
Yep, New York Fed put that out today. So that's 6.2, but I'm gonna say 6.8. So I'm saying
so over under 7. You got the low. Over under 7. You're taking the under.
I'll take the under. Yeah.
All right, I got $1 on the over.
You're on, Michael.
7.
We'll see.
Yeah. I mean, used cars are coming down, which is, I mean, I don't know. I don't know. There's a lot of oh man, that can keep going. Unitary labor costs are a scary thing that's on the inflationary side right now, where you're seeing people have to pay workers more. Well, that's a big deal. I'm telling you, wage inflation is real, and the Fed missed it. What happens first? Service sector, first time jobs, minimum wage up. They got theirs. They got their 10, 15. Dude, white collar, they're next. And their salaries are bigger.
Yeah, we'll see. I don't know on that one because I think it's becoming so transparent as to what's going on, where earnings are coming in right now and margins are getting thinner, that I think that it might have happened too fast and we might have missed the boat, is my take on it.
Yeah, it could be.
But
this is crazy.
The inflationary driver is twofold. So we're having to pay people more right now and they're less productive.
Yeah, no kid. Did you see that productivity number? Woo.
Productivity's down and
lowest
we're paying people
42
more.
years.
We're paying people more to do less. To be clear as to what that's saying.
Yeah, exactly. Man, lots of fun stuff. I love these conversations. Thank you for bringing a unique perspective to our channel. Where can people find you?
Find us at Life Goal Investments on Instagram. That's the best place. At
Awesome.
Life Goal Investments.
Thanks, buddy.